Hello everyone. Today in this video we will discuss about accounting for entrepreneur. So what is accounting? Accounting can be defined as the process of identifying financial transactions which can be measured in terms of money, recording them in primary books, that is journal, then classifying, summarizing, analyzing, interpreting the financial data into meaningful format. Then what is financial transactions? Exchange of goods and services between two or more persons or parties or firms for money or money's worth. So financial transaction includes an activity or events which can be measured in terms of money and must have impact on the financial position of the business. So for any transaction there must be two parties, one is buyer, another is seller, and there must be exchange of cash or credit between both the parties. In this case, Mr. Ram, the buyer, enters to the gift shop of Messrs. Shyam, shopkeeper. Then buyer asked for a bucket of roses and shopkeeper handed over Mr. Ram, the buyer, bucket of roses and demanded $20. Then the buyer handed over $20 to the seller and demanded a receipt. So this is a business transaction or financial transaction. Here both buyer and seller are receiving one and parting another. Here Mr. Ram is receiving bucket of roses in lieu of parting cash. Here the seller is receiving cash in lieu of parting a bucket of roses. Then basic element of accounting for any business. Every business transaction is recorded in the books of account in two phases. First journal, then ledger. Journal is the books of original entry and prime entry, and ledger is the secondary entry or final. In the journal, transactions are recorded in a chronological order, and from the journal, transactions are posted to the various accounts in the ledger. Then we prepare the trial balance, taking the balancing of all the accounts. Then we prepare the trading account, profit loss account and balance sheet. So in double entry accounting under modern approach, business can use any combination of 5 elements when recording transaction. These are assets, liabilities, equity, revenue, expenses. Then we should know the 5 elements, term 5 elements. One is asset. An asset is a resource controlled by an entity. Either he the owner of that asset or he possessed it by means of lease as a result of past events, and from which future benefit is expected. Suppose he leased the factory, then factory will earn income in future. Suppose he possesses computer, computer will use to do business in future, recording business in future. Then inventory also, it will be utilized in the business. So examples are cash, inventory, factory, computer, etc. Then liability. Something a person or company owes, usually a sum of money, is known as liability. Means when the business owes from bank or any financial institutions for the smooth functioning or expansion of its business, that is treated as liability. And the business has to pay regularly in case of term loan, EMI, which include principal plus interest. But if it is working capital loan, the business has to transact within a vested limit fixed by the bank. Then capital. Capital means anything brought by the owner into business, either in terms of cash or in kind. Suppose he has provided any asset, then that will be treated as capital. Here for owner, investment is the capital. Because in business is treated separate from its owner. So the income and expenditure of the owner should be kept separate from the income and expenditure business to arrive the true income statement. That is how much income is generated from the business or loss is suffered in the business, and the financial position of the business, that is known as balance sheet. Then revenue. It is otherwise known as gross sales proceed. It is the gross flow of cash, receivable, other consideration arising in the course of ordinary activity of business. Suppose you sold goods on cash, then cash will be inflow. If we sold goods on credit and we have given some period to the customer, then it will come under receivables or any other means arising in the ordinary course of business. Then expenses. It is the cost of operation that a company incurs to generate revenue, from which no future benefit is expected. Means its benefit is already exhausted. Salary, fees, rent, stationery, maintenance, these expenses will be incurred for the day-to-day running of the business, and the benefit will exhausted within that financial year. Then there are some fundamental rules of debit and credit under modern approach. If it is asset, increase in asset should be debited, decrease in asset should be credited. If it is expenses losses, increase in expenses losses to be debited, decrease in expense losses to be credited. If it is liability, increase in liability to be credited, decrease in liability to be debited. If it is capital, increase in capital to be credited and decrease in capital to be debited. If it is coming under revenue and gains, increase in revenue and gains to be credited, decrease in revenue and gains to be debited. Then total assets, that is balance sheet, is divided into two parts. One is left hand side is liability and equity, right hand side is assets. So accounting equation signifies that assets of a business are always equal to the total of its liabilities and capital or equity. So we will discuss it by means of some transactions. So recording of transaction in the books of Messrs. Gupta. Messrs. Gupta started business by investing $500 for a furniture shop. So for the business, cash comes to the business, that is asset is increased. $500 asset increase. Then capital or equity increase to the extent of $500. So asset is equal to liabilities plus equity, that is cash $500 is equal to 0 plus capital $500. Then Messrs. Gupta opened current account with SBI and deposited $100. When Messrs. Gupta deposited $100, then cash in hand will be reduced with $100. Decrease in assets should be credited. That means it will be deducted from cash in hand. Then cash at bank, increase in asset, that in the bank our cash deposit will be increased with $100. So cash in hand, one asset decrease, Cash at bank, one asset increase the same amount, that is $100, but liability and equity remain same. Then purchase goods on credit from Messrs. Ramlal, $100. Here the business is purchasing goods from Messrs. Ramlal on the basis of credit, and here our creditor is Messrs. Ramlal, and while purchasing the goods or inventory, that is increase in asset to the extent of $100. So cash in 100, $400 plus cash at bank $100 plus inventory $100, and the creditor $100 and capital $500. Then sold goods on credit to Messrs. Kiran for $50. Here when we are selling goods to Kiran on credit basis, our inventory is reduced to the extent of $50, and Messrs. Kiran is our debtor. Our debtor will be increased to the extent of $50. Then no change in liability and equity. So cash in hand $400 plus cash at bank $100 plus inventory $50 plus debtor $50. So total asset side is $600. Here capital $500, liability $100. It is also $600. So we know accounting plays a vital role in running a business because it helps the businessman to track income and expenses, to know his financial position of the business, what is the position of assets, liability and equity in the business. It ensures statutory compliance, means it will adhere to the rules of paying tax and what are the rules for governing the business, that has to be carried out. Then it provides investor, management, government with quantitative financial information which can be used in making a decision of the business. So, thank you.